Hello everyone, welcome to my accounting tutorial. In this session, I would like to introduce to you about the income statement. Before moving to the calculation part, I would like to introduce a very general details about income statement. First, I would like to explain the format and its compositions. Then we will learn how to record the transaction. Then we will prepare a very simple income statement. The income statement, or the statement of operations, or the statement of profit and loss, is one of the main financial statement which the company use to record profits and loss. So we start. A very first line is the revenue, or we also call sale or turnover. Then we're gonna have direct operating costs. This cost includes the cost of purchasing inventory, or cost of goods sold, or cost of sale. Then we have a subtotal, gross profit, equal to revenues minus for direct operating costs. Then we have indirect operating costs here. For example, this cost includes research and development expense, selling expense, administrative costs, and so on. Then we deduct the indirect operating costs from the gross profits. We're gonna have the operating incomes, or the earning before interest and tax, EBIT. After having the operating income, we deduct for the cost of debt financing. In this case, usually the companies own the interest rates or the bank charge for its debt financing. So we deduct cost of debt financing, interest rate from the operating income. We're gonna have the earning before tax, EBT. Once again, we minus for the tax rate, corporate tax rate. We're gonna have the income or retained earning. I want to make a very quick introduction, and so that's why I already set up the formulas, the necessary formula here for the company incomes. So let's remember, gross profits here equal to revenue minus for direct operating costs. We're gonna have gross profit. Gross profit minus for indirect operating costs. This includes R&D, selling, administrative. We have operating income. When we have operating income, we minus for cost of debt finance and tax. Cost of debt finance may include interest rate or bank charge. Minus for tax, we're gonna have the net income. So we can make further calculation from this point. We can calculate gross profit margin. equal to gross profits divided by the revenues. So this is a very general information about the income statement for companies. So let's move to a detailed calculation, and we will learn how to construct a simple income statement for a company. Let's move to the next slide. So I already set up here this balance sheet extract of balance sheet extract here. This is one of the important part of a company balance sheet, the shareholder equity. And I already set up the income statement here. We're gonna have revenue, direct operating costs. We will calculate gross profit, indirect operating costs. Then we have operating income. Finally, for the income statement, we record the company profits and loss. Finally, we're gonna have the net income. Net income is the same as the retained earning in the balances. So let's start. So here, very easy, we have the revenue equal to the revenue in the balances. It's a part of shareholder equity equal to 200. We have direct operating cost equal to, in this case, that's the cost of sale or the cost of goods sold. Then we calculate the gross profits equal revenues minus for direct operating costs or cost of goods sold. We have the gross profit equal to 140. We also have indirect operating costs equal to, in this case, the balances show the indirect operating costs as the other expense. For example, here I put here the salary which the company pay for each employee equal to 40. Then we calculate the company operating income equal to the gross profits minus for indirect operating costs equal to 100. Then we have the cost of debt financing. In this case, the cost of debt financing is the interest rate which the company pay for its loan, for its bank loan, equal to 25. Quite simple. Then we're gonna have earning before tax equal to operating income minus for cost of debt financing. Obviously, we have tax equal to A. Then, finally, we will calculate the net income equal to the earning before tax EBT minus for, we're gonna have net income equal to earning before tax minus for tax rate equal to the net income. So this net income is exactly the same amount as the retained earning here in the shareholder equity side in the balances. So that's all about the income statement. So let's review some important points. Hope it helped. So when I was a bachelor student, I was very confused because uh, different book or different lecture, they use a different term for revenue, sale, operating profits, or earning before interest and tax in different case. So that made me I I was very confused about that. So I have prepared a very easy step, very easy review here for you to have a clear point of view, and we can easily define the exact term. If someone changed uh, one of the term here when they construct um, the income statement, don't to be confused about that. It totally the same things. For example, number one, sales or revenue or turnover here is the revenue which the company can earn from selling product and service. A sale equal to revenue. Number two, operating profits or earning before interest and tax (EBIT) are the same things. Direct operating costs are the cost of goods sold, the cost that the company purchased, uh, inventory, material to produce uh, products and or to uh, manufacturing the good. So direct operating costs are the same as the cost of goods sold, or we also call cost of sale. Indirect operating costs include R&D, research and development spend, selling spend, administrative costs. Um, that's all about the cost other than the operating costs that the costs are directly related to the operations of a company. Cost of debt financing includes this could be interest fee, bank charge, and about generally about the interest fee when a company borrow a bank loan, so the bank charge them an interest fee. Net income, we can use net income, or we can call it net earning, retained earning, uh, or retained profit. They are the same. Remember, uh, when we uh, I want to move to the previous slide. When we calculate net income in the income statement, this amount are this amount net income is calculated from revenues, direct operating costs, indirect operating costs, cost of debt, and tax rate. This amount is exactly the same with the retained earning on the equity side in the balances. So this is the end of the video. Thank you for watching. If you have any further question, please put them in the comment. And if you like it, you can like the video and subscribe. Thank you so much.